Hi everyone, what are you doing? Hope you're doing well. Welcome to another video. Today I want to take a few minutes to talk about inflation, hyperinflation, interest rates, and if you should invest in those scenarios, especially in the stock market. Spoiler alert, you should, but more on that later. As always, it's not financial advice. I'm just here publicly documenting my own opinions, personal investment decisions, so that in a few years I can look back and see what I was thinking when I made those decisions. Please don't base any of your financial decisions just because you watch one YouTube video. Especially for me, I'm just a 23-year-old kid, young adult, whatever you want to call it. I live in Portugal, and now that we are talking about inflation, during my lifetime I never had to deal with high inflation scenarios. The only contact that I had with hyperinflation scenarios was listening to my college classes of economic history,
where we had like in 1922 Weimar Republic or the post-war Germany, they had hyperinflation. 1945 Hungary, post-war also they were devastated, so hyperinflation. 1992 Yugoslavia, hyperinflation. 2000 let me see if I remember, 7 Zimbabwe, 2009 North Korea, and 2016 more recently Venezuela.
All the things that they have in common is that there was some kind of catastrophe that triggered that hyperinflation, the printing and printing more money, and now we are living through or finally exiting a pandemic. So if something something shows up, we might enter those scenarios, but at the global scale, and that could be devastating, and that will be the topic of today. But I have a few friends that watch my videos, and I know that everyone here is not at the same level in terms of macroeconomic knowledge, so I will start things slow this time. So inflation. The more you know about economics, the less you know how to define inflation, but just let's keep it simple because even great economists have a hard time defining exactly what is inflation. But if you just pick a general definition, it's just the general increase of prices of a specific basket of products and services, but essentially you just lose purchasing power over time. Let's suppose one apple today costs €1 and you have 500 euros or $500, whatever you want to use as a currency, and you spend each day of the year $1 in one apple. Let's suppose we have a scenario, so you reach to the end of the year, you spend $365 or euros, and you still have some savings left. But let's suppose inflation is 10%. That means in a span, in the next year, one apple, instead of costing €1 is going to cost €1.10. In the second year, it is going to cost €1.21, and so on and so forth. So in, let's say, 7-8 years, one apple is going to cost €2 or $2, and if your wage or your paycheck hasn't increased, you will not be able to afford your apples, while in the first year you could afford those apples and still have some life savings. So that's something for you to consider, because I know there's a lot of mentality here, especially in my country, Portugal. I love Portugal, but people often have the mindset, oh, okay, you earn, you save, that's it. Nobody wants to really invest. But let's suppose you're having a kid, and this is especially true for my generation, not so much for my grandfathers or my parents' generation, because nowadays we have access to all things like information. It's really easy. You can just invest by installing an app. Before you really needed to have like some kind of possessions or wealth or money to be contacted by a bank, and only then you would invest. Still, there's a lot of friction when it comes to investing even today, and my generation cannot afford to make the same mistake. So let's suppose you are having a kid, or you have plans to having kids. If you would just save, let's say, $1,000 each year, so that when he turns 18 he could have like some kind of emergency fund. I'm always a fan of emergency funds, but the thing is, the money that you saved in the first years is going to be really losing all of its purchasing power in the later years. So my recommendation, and remember, this is not financial advice, yes, you should always aim to have an emergency fund, and this depends on your risk tolerance or your safety nest. How big do you want it to be? Maybe when you're older you want to have an emergency fund that will last you maybe 1 year, 2 years. When you're younger like me, maybe your emergency fund just needs to be maybe 3 months or 6 months. That's what I personally have. I have my emergency fund, cash. I know it's losing purchasing power each year, but some emergency might happen, you need that, and you are not forced to sell your investments, because might not be the best time to sell them. So always have an emergency fund, but having all of your savings in an emergency fund not the way to go. At least that's what I predict for the next following years, and that's why here in my channel, instead of just documenting beer growth or beer time lapses, vlogs from my trips, I'm also sharing some of my financial decisions, so that here the people around my age, my network, wherever you want to call it, also feel inclined to dig more about these subjects. But I'm getting off topic. Now you have a broad notion of what is inflation. So what causes inflation? Basically just think of higher inflation as two main factors. The amount of currency that's circulating. Recently, in the past year or so, you've been seeing all these bazookas or stimulus checks, trillions and trillions of dollars, euros being printed. Yeah, that's one of the factors that might cause inflation. And I'm saying might because there's a second factor, and that's the velocity of money. You know, the time the money exchanges ends. Because if you just dump $10 trillion in the economy, if no one is spending that money, that's not going to really inflate prices. Prices will remain the same. But let's suppose people haven't been spending for the past year or so, and now they have all this money piled up, or there's a lot of more liquidity in the market. Well, if you increase the demand, the supply is the same. Of course, that's going to drive up prices, and that's why you're seeing right now lumber prices spiking, steel prices, all kind of commodities spiking up. So what can you do in this scenario? Or is it wise to invest in the stock market? From what I learned in economy classes and so on, the best way to protect yourself against inflation is inflation hedge assets. One of those examples is gold. Do I personally agree with this? Meh, that's debatable. Maybe I just have some kind of trust issue, because if someone was to sell me a gold bar, how do I know that's really gold? I know there are certificates and stuff like that, but I'm not a huge fan of precious metals because they don't offer you any kind of return. Then that's the purpose of them, just to be fair to precious metal lovers. That's just an edge against some bear times, essentially. And that's the purpose. It's not something exciting, but when you're younger like me, you are willing to take a bit of more risk, so gold might not be a good idea. Other things that they discuss, maybe real estate. But if you're not living in the US, for example, here in Portugal, I don't know anyone from my group of friends that will be able to even afford a house or to apply for a loan to buy a home. That's how things are right now, so maybe not the best idea for like investing in real estate. So you can invest in other commodities expecting them to go up. Not easy, depending on your situation. Here, I think a good way to hedge against inflation are some specific stocks of companies that can push the prices to consumers. So let's suppose we are living through a high inflation period. What are you going to cut on your expenses? You might not need a new TV, you might not need, I don't know, a new laptop. You can push that purchase maybe in two years forward, but you will always have to eat. So a good idea for inflation hedge stocks would be companies that can push prices of things that people really actually need to buy. I can give, and this is not me trying to prop some stock up, but I personally invest, and you can check that on my Instagram page, cadete.invest, or in my playlist investment decisions. I invested in Walmart, I invested in Kroger. Okay, they are not amazing growth stocks, or they will give me incredible returns, but they are stocks that tend to, because they are like grocery retailer or just retailer where people go buy their daily needs and groceries. So yeah, in an inflation scenario, those companies can push the prices because people still need to eat. And that's just a quick example. I always recommend you to do your own research. I could be entirely wrong. This is just my way of thinking, that in some years I will look back and think, that's why I was investing, because I was a bit concerned about inflation. But also, I think it's also fair that we might not see any like hyperinflation or high inflation in the upcoming next years, because if you go Google for news, maybe 2012, 2013, each year you see the fears of hyperinflation, everything is going to crash, we are doomed. And if you haven't invested for the past 10 years, you lost one of the biggest bull markets in history. So you were losing by not being invested at all. So yeah, even if it's to make mistakes, I'm not a fan of losing money. If you're not invested at all, maybe it's a good time for you to start learning about this stuff. And sorry if I'm getting off topic again. Inflation, stay focused, Pedro. Yeah, because this is just a rant of me talking about what's coming through my mind right now. So another key factor for inflation and what's concerning are the interest rates from central banks. And right now we are living really an iconic historic moment because interest rates are at all-time lows. Yeah, all-time lows. I don't know if that's a thing. Yeah, but they are the lowest they have ever been or near that. So that means that borrowing money is really cheap. So that only increases this threat. And if we start seeing inflation or high inflation, central banks will be forced to lift interest rates, because if you lift interest rates, it will cost more to borrow money, so that will tighten our economy, and you can fight inflation that way. But if you want to know more about this, I don't want this video to be super long. I have 3 videos about talking about long-term debt cycles, how to fight a recession, or how to hedge against inflation. Those 3 videos are really good, and I go more in depth than right now. They were made like 10 months ago or 12 months ago, so I speak a bit slower, so just put that video on 1.5 speed if you think I'm speaking too slow. Yeah, but that's another concern. And if you could borrow, but then again, I cannot speak from my experience, because here in Portugal you cannot really get a loan that easily. But maybe if you're living in the US and you're really convicted that there's going to be high inflation in the upcoming years, maybe that would be a good idea for right now for you to make like a loan or borrow money, because with time, with over decades and stuff, your purchasing power, like your loan, will become cheaper essentially. So that might be a good idea for me or for the people that are living in Portugal. Most of the people that are probably watching this video, that's not an option, but I'm putting that option out there. So yeah, my thoughts are, yeah, invest. Even if there's a high inflation, invest anyway. You'll be better off. Each year there will be fears, and if those fears don't come through, like it has happened before, like the bubble will keep growing. You never know when it will pop, but until then, the alternative, if interest rates are really low right now, you cannot have any alternative of return. So the only way for you to get anything is to be involved in the stock market. But there's one thing. What if interest rates rise? Bond yields also rise, so people might exit their stocks, because if you can have your money in a treasury bond, at least that's secured or seen as a secured return, people will exit the stock market and prices will crash. But at the same time, you cannot really increase interest rates that much, because we are at a point of has so much debt right now that's really unthinkable, or I don't think that's possible, to be honest. But I've been proven wrong several times along my life, so I might be wrong, but I don't think that's an option. Also, if you look, for example, for Federal Reserve, the Fed, Jerome Powell, he was stating a few months back, okay, inflation is going to be temporarily higher right now because we are not adjusting the demand and the supply right now. There's going to be a lot of supply now that the economy is reopening, and a lot of demand, and the supply it's still like not at the levels that it was before. So this temporary inflation, that's why in the previous month the CPI index was like 4.1 or 4.2%, because it's comparing to year over year. So yeah, of course, last year everyone was hoarding cash. Everyone thought a panic, it's the end of the world, we are all doomed, this is the pandemic. So everyone wanted to keep their cash. So your purchasing power, the dollar, the euro, obviously got stronger as people were selling off all their assets. So right now we could see an inverse situation, or like the same situation, if people think that we are going to have higher interest rates and they can have other returns, so the stock market would essentially crash. That would be a good buying opportunity. But yeah, like I was saying, if you compare year over year, of course, this temporary is going to be it's going to be look bad, but if you look over 10 years or 20 years, it's going to be look like more or less like the average, or things are back to normal. So my recommendation is, as always, don't panic. Jerome Powell was also saying to don't panic. He was warning about this spike, this temporary spike in inflation. We could see this, I don't know, 6 months, 18 months, whatever, but it is just temporary. And even though he said that they weren't planning to raise interest rates, people panicked anyway. I feel like this is like when you're a kid and you're really sad or about to cry, and you're not going to cry, but someone tells you, please don't cry. That just gives you more motives to cry, or the urge to cry more. I think that's what's happening right now with the market. So if I see in the next weeks maybe some pullbacks in some stocks that I'm watching, might be a good buying opportunity. But then again, that's just me. That's what I wanted to say today. Thank you for watching, and I'll see you in the next video. Bye.